Most traders are told to focus on a positive risk-to-reward ratio, but what if I told you that a negative risk-to-reward ratio can actually lead to consistent profits in Forex? Certain strategies leveraging a negative risk-to-reward ratio can work when paired with high-probability trades and disciplined execution. What is a risk-to-reward ratio? It's the ratio between how much you are willing to risk to gain a certain amount of profit. For example, risking 20 pips to make 10 pips would be a 1 to 0.5% risk to reward. Most traders aim for a positive risk to reward example, risking 20 pips to gain 10 pips, but sometimes a negative risk to reward can work in your favor. Why a negative risk to reward can work? A negative risk to reward ratio can be used effectively in strategies that have a very high win rate, for example 80 to 90%. In these setups, even small gains add up over time. In scalping, where you take smaller profits but the trades have a higher likelihood of success, you might risk 40 pips to gain 10 pips. In fast-moving markets, small, quick wins can be easier to capture than larger, more uncertain targets. By focusing on shorter exits, you can achieve consistency. Example: price action trading near strong support or resistance levels where quick bounces provide frequent small wins. Minimizing drawdowns. A smaller profit target can reduce the time your trade is exposed to market volatility. This way, you're less likely to face large, unexpected market swings. Example: in a ranging market, scalping between tight support and resistance levels might favor smaller, frequent gains. Consistency over big wins. The key is to win more trades than you lose, even if the reward is smaller than the risk. You could lose one trade and still be profitable if you win 6 small trades consistently. Pros of using a negative risk-to-reward ratio. Higher win rate. Since the profit target is smaller, trades tend to hit the target more frequently. Psychological benefits. Winning more often can help maintain confidence and avoid emotional drawdowns. Works well with scalping or high-probability trades where the goal is small, quick profits. Cons of using a negative risk-to-reward ratio. Bigger losses on each failed trade. If you don't have a high win rate, a negative risk-to-reward ratio can wipe out profits quickly. You need to ensure that you are consistently applying the strategy with a focus on taking high-probability trades only. While a negative risk-to-reward ratio may sound risky, when paired with high-probability trades and strict discipline, it can lead to consistent, reliable profits over time. Stay tuned for my next video. Please like and subscribe to follow my journey trying to grow small accounts over time with my compounding strategy.